and welcome to the Build and Exit podcast. I'm Julie Wilkerson. I'm the owner and founder of Wilkerson Accounting Solutions, and I started the podcast off the back of the work we do in the business because I noticed there was a real gap in the acquisition market for financial understanding for business owners and investors. So I have a lot of guests come on the podcast and we talk about exit planning, acquisitions, and investments. So I'm really excited to have Sam Oliver with us today. Hi, Sam.
Hi there, Julie. Thanks for having me.
Oh, you're welcome. So Sam's going to tell a really interesting story today because we have a lot of buyers come on, but Sam's actually successfully sold a business and was part of an earn-out clause as the seller. So it's going to be a really interesting conversations. But just a bit of background about Sam. So he was actually a sole founder of a marketing technology company that actually grew to have about 37% market share in that industry. He then successfully sold to a hedge fund organization and was actually part of an earn-out clause, obviously where he got his deferred consideration, and we'll come into it, but there was obviously some things that came out the woodworks, and Sam had to spend quite a lot of money on accountants, and it was quite an interesting story, so I won't steal the thunder. I'll let Sam explain it. So that's why Sam's on today to talk about his experience of selling this business. So first of all, Sam, I just want to hand over to you to just tell a little bit about yourself and why you wanted to come on the podcast.
Oh, thank you so much, Julie. So running a business from completely zero, starting, gaining investment, and then getting it all the way through to being valuable, so valuable that another company wants to buy it as an asset is a great journey. And also a very hard one. And I think the lessons that I learned, particularly at the very end in selling the business, are super interesting and useful for other entrepreneurs. In particular, some of the things that went wrong, great to share with other people. So that's kind of my main motivation for chatting with you today.
Yeah. So if we go back to the beginning then, so you sole founded this marketing technology firm, ended up growing it to 37% market share. So just talk us through a little bit about that's quite a big thing in itself, really. So talk about just a little bit about the journey and, how you managed to sort of do that as a sole founder.
Sure. So when I originally started the company, I was thinking about it from the view of a tenant. So I'd been looking to rent property in London. I'd inquired with a lot of agencies, and it was so frustrating that you would email estate agents and very few of them would actually reply. And I tracked the statistics, and it was over half of inquiries sent received no reply. So I thought, well, what would be super neat here is if I email a estate agent, can I just book a viewing to view the property? I don't really want to have a call and tell them all my details. I just want to come and look at the property and see if it's a good fit for me. So I pitched for angel investment and I raised £150,000, and I used that money to go and hire a development team and build a viewing booking tool for estate agents. And then I hit the pavement and tried to sell this tool to estate agents. And we got a handful of customers, but it was a real fight. And it turned out that the estate agents, they didn't really care that they were ignoring half their customers because the customer wasn't really the tenant. It was actually the landlord. And they had so much inbound business that it didn't matter if they ignored half of them. It took me a long time to really listen to the customers and discover that actually there was a product they were willing to buy. It wasn't the viewing booking tool that we had built. It was actually a pre-qualification tool. So if someone inquired to view a property for sale or to rent on Rightmove or Zoopla, they wanted to know if that person was a tire kicker or if they were really a good quality prospect that they should make the effort to show around the property. So what we ended up developing was a pre-qualification technology, and that was where we found this product market fit. Because for those busy agents, where they had so many inbound inquiries, it really started to help them. From that product, we sort of kept asking the customers what they needed and did a really good job of listening to them. And we learned that the big thing they needed was more business. So they wanted more people who had houses to sell, more people who had houses to let, and they wanted to maximize referrals, in particular mortgage referrals and insurance referrals. So a lot of what we did was developing technologies like automatic Facebook advertising campaigns to help them get new business, lead magnets like instant online valuation tools that they could put on their website where someone could put in their details and postcode, and we would give them an instant online valuation of their property, and the estate agent got a lead. And a lot of sorting and organizing technologies. So dashboards for managers of business to see how quick their staff were replying to business inquiries, to see which sources of leads were giving them the best conversions, a lot of tracking, a lot of automating. If a lead was a very high quality lead, we would cause the office phone to ring. We would do a lot of nurture and chasing with emails and text messages. So yeah, we developed some very good industry specific technology, which is probably why we were able to grow it so significantly.
Yeah, interesting. So you obviously did a lot of work and a lot of listening to the customer, which I think is really good. So you did successfully grow to 37% market share, and then you went through this exit phase. So did you plan to have an exit in the business?
I think the long-term goal of the business had always been to build an asset, to make it sure it was profitable. So either I could have it as a company that was a cash cow for me or to exit. So it was one or the other. But I do think that having a profitable business does make it easier to exit.
Yeah. Okay. So you had that in the back of your mind. So then what year was it that you sold it? Because you sold it to quite a large hedge fund, didn't you?
Yes, we sold it to Tosca Fund. They were doing a roll up through a company called Nurture Group, which was buying lots of different technology businesses to put them all together. And we sold it in 2021. One of the sort of reasons that I was prompted to sell was in 2020, in the pandemic, like a lot of businesses, we went through that very difficult phase of we were profitable, doing really well. The market then completely shut. All our customers stopped paying us. We still had to pay staff before furlough came out. We lost a lot of money going from profit to zero revenue with lots of expenses. And I think that fortunately, the property industry really bounced back, and it was some of the busiest market times after the pandemic. Everyone wanted to move house or change house, which was great for the market. But for me as a business owner, it did make me realize just how risky that asset was. That, yes, we were back to profitability, but it can go to zero. And it made me think, well, actually, if I do get a good offer, I would be happy to cash my chips in and take my risk off the table. So the pandemic was a real eye opener for me, particularly when we had those cash flow issues. I had to remortgage a property to be able to personally fund the business. And it meant that I had like a lot of risk in the company, and getting the opportunity to take that out was also quite a big decision-making factor for me.
Hmm. So, yeah. So then when you did sell it, I mean, how did you find the seller? So did you go through brokers or did they approach you? How did that come about?
So we had a competitor based in Europe, and they had sort of courted us a little bit over the years. They flew me out to Sweden to meet their team and to make an offer. So we had an offer from them. We also had one of our biggest customers was a distributor, and that actually was Nurture Group. So they sold our software to their customer base, and they also made an offer as well. And neither of the offers were really good enough for me to want to sell the business, but we were able to leverage the offers against each other to create some competition. It eventually led to me having a meeting with the hedge fund managers. And at that meeting, it was interesting because the company was at a stage of really fast growth. And although I did see the risk of not cashing in the chips and selling the business, it was also at a really exciting growth stage. So when I went into the meeting with them, it was to say, I've come in person to say thank you very much for the offer, but I don't really want to sell. Like, if I sold the company, I don't know what else I would do. I was in my early 30s. I didn't really have anything else I wanted to be working on. I was enjoying the process of running and growing a business. So I said to them, this is why I'm so excited about the company. We've got this great market share. We're becoming a market leader, and I'm really enjoying growing it. And I love the technology aspect, and I don't want to sell it. And they came back and said, well, what's your number? What would you sell it at? And I had thought that question might come up. And I had sat down and practically thought, what number would I be happy to sell the business for? So I gave them my number, and they sort of said, okay, let us work at this and see if we can come back with an offer that can get you that number. And the offer they came back with was the earnout structure, where they said, okay, this is based on your financial performance. This is what we would pay for your business today. We know that's not what you would sell it for. And you think it's going to grow a lot and be worth a lot more. So if you're able to, within 12 months, hit your growth targets, we will give you a revenue multiple that will give you the full amount that you want. And it was uncapped. So if we grew even more, then we could make even more on the trade sale as like a motivator to grow.
Okay. So you went for the deal. And I know that there's a few gritty stories, as I call it, in the earnout structure. So you obviously did the deal because you got into the earnout, because I think you had an earnout for a couple of years in the end, didn't you? Didn't it finish in 23?
So the earnout actually finished in 22, but I stayed with the company a little bit longer until 23. Yeah.
Okay. And I know you've told me that then. What happened as part of the earnout? Because I know you mentioned to me that you had to bring a third-party independent accounting firm in or something to look at the earnout structure. So what sort of happened in that earnout stage that caused negotiations,
how did
I suppose?
It all go so wrong?
Yeah. How did it all go so wrong? Yeah.
So we had a really good shareholder who was very skeptical. And he said, Sam, I don't think the earnout's going to work. And this was useful. So the first thing he said was the initial cash consideration. If that was all that you got paid, would you still be happy with the deal? And I actually thought to myself, do you know what? If that was all that I got paid, I'm still happy with the deal. It's still a great deal. It's good for me. It's good for the shareholders. Obviously, I want to get the earnout, but if they didn't pay me a single penny or all went horribly wrong, I was still happy to take the deal. What he advised to make the earnout process smoother was a clause in the share purchase agreement that essentially stated every single month you should run the accounts, the monthly management accounts, as if it was the final month of the earnout, and you should agree, buyer and seller agree on the numbers. And that way you have 12 months to iron out the process, you've got everything in writing, and there's going to be no discrepancies around what happens at the end. So we did this religiously, and we had it all documented and stored, and we went over the process, and we had an accounting process that both sides agreed on. And then in the final month, the other side came back with their final month's working under a completely different process than we'd agreed and run every other month. And they basically said, we're going to pay you a lot less than what we had previously calculated. And for me, that was an exceptionally difficult call because every month we had agreed, and I had a written email from the finance director and the CEO of the purchasing group from the previous month saying, this is the earnout amount. And then they gave me an offer even less than that, which I already had in writing as agreed. So I couldn't believe what they were trying to do in terms of the low payment.
Yeah. So basically, you've gone against what they've agreed and now trying to pay you less. So what did you have to do to challenge it, I suppose?
Yeah, so the earnout had quite a formulaic process in the share purchase agreement to deal with disputes over the deferred consideration. And I think here I was slightly naive because I expected, first of all, that they would want to keep me in the company. So not to blow my own trumpet, but in terms of the growth, in the year of the earnout, we did over 4 times growth in the company. So it was like a fantastic year. We smashed all our targets, really happy customers, PLC customers moving from 12-month contracts to 3-year contracts. Like we did very, very well. So I'd assumed, one, that they would not try and pay less, that they would try and keep me on side and retain me, and that they would try and just resolve everything and there'd be a lot of good faith. But actually, the other side's approach was to run everything to the letter in the contract. So, for example, from the end of the earnout period, they had 30 days to provide their offer of doing the account. Now, I had the account done day one, ready to share with them, and nothing would have stopped them day 2, day 3, reviewing it in the normal process that we've done every month and giving me a number. But they waited until the very last day to give their offer. I went back to them being like, well, this offer is not acceptable. It's not according to the process that we've agreed and we've been running. And what the contract then had was a dispute resolution process. And the first stage was another 30 days for the buyer and seller to negotiate. So they invited me into the office and they basically said, take the offer. And I said, no. And they said, you're not willing to take the offer. And I said, no. And they said, okay, well, we've tried dispute resolution. We'll wait until the end and we'll move on to the next step of the process. And I found this really funny because there was no effort at dispute resolution from them at all. They basically said, take our offer or we'll just follow the process. So we followed the process, and on the last day of the negotiations before it moved to the next step of the dispute resolution, I got notified that I was at risk of redundancy and they were going to terminate my role from the company, which I was completely surprised about because the performance had been amazing and my plan had been to stay on with the company and continue to help them grow. So that was a bit of a shocker for me, and it was also interesting because it split the process. I had an employee hat where I was being made redundant, and then I had a separate shareholder hat where there was dispute over the deferred consideration. So the dispute over the deferred consideration, we then had a 30 days to choose an expert determinator. In this case, the expert determinator had to be a chartered accountant, ICAEW, and both sides had to agree. So my process was fairly simple. I messaged all of the chartered accountants and I said, look, this is the work that we want to do. Can you provide a fee quote for it? And of all the listed accountants, I think I got about 34 replied with fee quotes. And I just gave a spreadsheet to the other side and I said, look, these are all the quotes. I don't really mind which accountant we use. Please, can you pick an accountant or suggest an accountant? I have no connections to any of these accountants. And the average fee quote was about £15,000 to do the expert determination. The other side said, no, we don't want to use any of these accountants. And I said, okay, no problem. Can you suggest an accountant? They didn't suggest an accountant. They just waited for the timer to expire and for the 30 days to expire and to move to the next stage of the dispute resolution. So the next stage of the dispute resolution was if the buyer and seller can't agree an expert, you have to then appoint the ICAEW, Institute of Chartered Accountants for England and Wales, to select an expert determinator. So I then had to go to the ICAEW and we had to pay them £12,000 for them to do the exact process that I'd already done, where they just picked the accountant. The first problem here for me was we had then moved to kind of the end of the contracted dispute resolution time. So now there was no fixed number of days that the ICAEW had to do this by. It's just however long they take. There was also no fixed time that the expert determinator had to make their decision. It was just however long they took. So there was no recourse for me as the seller to say, if the ICAEW takes 3 months, do I get paid interest on the deferred consideration? What happens? So the ICAEW took a long time. They took about 2 months to appoint an expert determinator. The expert determinator then said, okay, I'm going to get this work done for you within 6 weeks. They then took about 3 months to do the work. The very difficult thing here is when the ICAEW appoints the expert determinator, there's no competition. It's like a monopoly. So that expert determinator has got their day rate and they're just going to charge their day rate for as long as it takes. And there's no recourse, there's no fee quote from either side. So that £15,000, which was the average quote for doing the work, ended up being almost an £80,000 accounting bill. So if you put the accounting bill and the ICAEW fees, you've got the best part of £100,000 spent on accounting for the expert determinator, whereas it could have been 15,000. So an absolutely whopping bill.
So who paid that 800,000? Did you pay that or did the business pay it?
50-50 split.
Right. Okay. Yeah.
So for me, it could have been 7,500 and it ended up being almost 50,000. The other thing that was exceptionally annoying for me was it then took almost a year to get paid. So there's a year of lost interest on the earnout amount. I can't complain
Yeah.
too much because when the expert accountant had done their determination, they ran through the process, which was much more aligned to what we'd done every month as per the contract. And they ended up ruling in our favor and ordering the buyer to pay almost double what they'd originally offered. So the process ended up protecting me and the shareholders, and we did get paid. But wow, was it a stressful, painful process where it was really drawn out and took a long, long time.
Hmm. And what do you think? I mean, I don't quite know what different, because you obviously had a good, I suppose, structure to what happened if you didn't agree the earnout. So from your side, Sam, in terms of the uh, earnout structure and everything that you built originally, do you think there's anything you could have done differently to protect yourself from it, or do you just think they tried to get out of paying?
I think I was a little naive in expecting that there would be more good faith. And also, I think I overvalued myself. In terms of leverage, I thought they wouldn't want to fire me and piss me off and give me like a shit offer. I thought they would be keen to retain me and that they wouldn't like mess around with putting forward a silly offer. In terms of if I was to do it again, I would definitely do things differently. I would probably review the contract as if I was not on speaking terms with the other party and that they were going to make every single clause be activated, which is exactly what they did. You know, they took a maximum time for every clause. What I would have done there is I would have brought the timelines down. I would also probably have basically said, if it goes to arbitration, the buyer has to pay the fees. So in terms of like the legal fees, if they're going to put, like the buyer's the one that's putting forward the offer, and if the offer's not accepted, I would have just stipulated that they have to pay the fees. I think they would have then handled that a lot differently in terms of choosing the accountant, or that there's a fee cap for the seller, like a reasonable fee cap. And those are probably fiddly things to negotiate. But at the start, when you're doing the deal, it's all goodwill. So I think there's a lot more leverage to push back and say, look, it's going to be your incentive to underpay on the asset at the end because the deal's already signed and done. The other thing that I would have done is I would have looked at a way to keep the assets in escrow. So when the earnout started, we began a 100-day plan. And that 100-day plan was essentially giving the buyer the control over the entire business. So they got access to all of the banking, all of the passwords, all of the infrastructure, all of the IP. And what I think I would have just done is in the contract, I would have said that 100-day plan only happens when the earnout has been agreed, because the risk for them of then, you know, alienating me with what they knew was a stupid offer and just trying to get a discount because that's how they decided to operate. I think their mathematical calculation around the risk of the assets would have been much higher then. So essentially finding a way to put the IP into escrow and say, you don't actually own this business until you've fully paid for it. And I think that would have been much more powerful to do. Yeah.
Hmm. Yeah, it's interesting, isn't it, that they made all this. I mean, ultimately, what it sounds like is they just kind of thought you would just accept the offer and walk away. That's what it kind of sounds like. And obviously, you pushed back, so they then took it to the next hurdle. And it's interesting, isn't it, that they let it go all the way through to the ICAW picking the accountant, and then the accountant actually came back and ruled in your favour. So so I wonder whether it's strange that they let it get that far. Whether they just thought they'll, take the risk because they thought you would just walk away and just take the offer that they're giving you rather than fight it. Some people might not have fought it. They might have just taken the offer, and then not be bothered with the hassle of it.
I think it's like, I don't know because I'm not them, but I've thought about this a lot. And my assumption is if you buy 10 or 20 businesses a year, and if in every single one you try and save a chunk of money by doing a bad offer, every now and again you'll end up saving money, percentage based. Some people will take the lower deal and not fight. And even if you do have to fight with some of them and go through a process, it may end up still saving you money. So I was super disappointed. I thought there was a lot of value destroyed for the company. I thought like retaining me and the amount of money they were trying to get out of paying me, we could have made that like could have made that money within the time period that we spent fighting about it. But I guess it's just an operating mode. It is interesting. Now that I've done more due diligence, I have heard from contacts in my network that the specific fund, some people just avoid them because of their practices. And I think that maybe I should have done more due diligence. But that said, I would go back to the point that I was still happy with the deal, even if I hadn't got the earn-out payment. So it's a balance you have to make.
Yeah, that's it, isn't it? And I think a lot of people, when they're looking at selling, the thing with selling to bigger corporations is that you don't tend to get all the fluffiness around what you tend to get if you sell to a smaller party. So a smaller buyer probably can't offer as much money, but maybe have a bit more ethical practices, or, will keep the staff and they'll need the business model. Whereas the bigger businesses tend to offer a bit more, but then you don't tend to get the niceties around that more relationship side of things that probably you get with smaller buyers, is what I see from seeing so many deals anyway.
Yeah, I think that's spot on. I mean, what I have to say about the other side is I think they did everything like legally. They followed the contract to the T. And I think it's the difference between the spirit and the letter. Like they did everything to the letter of the contract and nothing to the spirit.
Yeah. So, oh wow, it ruled in your favour in the end. So if we just briefly, I mean, we're not far off coming towards the end of the podcast, but maybe we could just touch on, because I know now you're also a co-founder of Openfi. So that's obviously your new venture. So just briefly tell us a little bit about that, what you're working on now.
Yeah, so in the last company, the majority of what we did was pre-qualifying leads before they were booked in for a viewing. And we were using questionnaires to do this. So quite old-fashioned text messages and questionnaires and emails and questionnaires. And we only worked in the property industry. And we did tens of millions of inquiries a year by the end of the business. What I'm really interested in doing with this new company, Openfi, is helping businesses pre-qualify website traffic. So, for example, if you have 1,000, 10,000 visitors a month coming to your accounting page, how do you increase the number of people that get in contact with you to find out about your services? And then how do you pre-qualify and only speak to the ones that are actually good? So what we've built is a really cool piece of artificial intelligence and a really easy WhatsApp button. So we put the WhatsApp button on a company's website, which people love to click and engage on WhatsApp. And then all of the questions that they ask about pricing, how the business works, the setup process, onboarding, the AI knows the answers to. So it's read all the website content. And the AI is trained to ask all the pre-qualification questions to ensure that they're a serious business prospect. And if they score enough points, it then books in a call with someone from the business to take that conversation to the next level. And we're doing this industry agnostically. We've started with some mortgage brokers, but our big focus is on professional services and helping people generate more business from their existing website and also save time for their sales team to only speak to the really good quality leads.
Oh, interesting. Sounds really good. So anyway, so I just want to thank you for coming on the podcast. It's been really great to hear your story. And also, from the seller side, I think we haven't had as many sellers on the podcast as buyers. So I think it's going to be really good support for people who are, also doing earn-out clauses themselves on the buy side, but also sellers who are going through earn-out clauses of what to look for. Because obviously it does just go to show that it's not always done and dusted when you sign on the dotted line, is it? There's things that can happen afterwards.
Spot on. Well, thank you so much for having me.
No, thanks for coming. And I just want to say thanks to all our listeners of the Build and Exit, nearly at 5,000 downloads now. And we're just growing the channel. We've got loads more guests in the pipeline. So if you do like our channel, hit the subscribe button so more people can find our channel. And I look forward to seeing you again soon.